You've been operating with Darwinex ZERO for a while, and if not, and you're interested, below, in the description of this video and in the pinned comment, I'm leaving you a registration link with a €20 discount on the service fee. But I'm sure that at some point you've wondered how I could increase the multiplier, that darn multiplier. This is the video you've been waiting for. Disclaimer. And we begin. You're surely already familiar with the ratio bar, or the more commonly called multiplier. This is the value your risk management engine will use to replicate the operations from your virtual trading account. The leverage or lot size with which Darwin replicates your trading will therefore depend on the monthly risk you are assuming. You can view this ratio bar or multiplier in the Darwin Live Trades tab, at the bottom left of your Darwin panel. By the way, this chart is only visible to you, meaning, if your multiplier is at 1x 0.50, it signifies that for every one lot you open in your trading account, the RME will replicate only 0.50 lots in your Darwin. In other words, it will be reducing the Darwin position by half. And this is because the RME aims to adjust the monthly risk of the Darwin to 6.5% bar. If your multiplier is at 1x2, well, same thing, for every one lot it will open double the position in the Darwin. So, enough rambling, we've seen that already. Okay, come on, I'll leave the video where we explained that up here, in case you didn't see it. To measure risk, Darwinex will use the last 45 days of your trading operations conducted through the bar, which can be consulted in the penultimate section of the Strategy Analysis tab. If your trading history is less than 45 days, Darwinex will use the data it has. So, all this means that the higher the ratio bar you assume, the lower your multiplier will be. And the lower the ratio bar you are assuming, the higher your multiplier will be. But how can we modify this ratio? Based on what parameters does Darwinex ZERO determine you're assuming more or less risk via the bar? Well, there are mainly 5. 1. Number of operations during 45 days. I'm sure you'll agree with me that we'll be assuming more risk if we make 3 operations a day than if we only make 1. 2. Stop-loss distance. Here we normally talk about the distance from the opening of the operation to the maximum permitted loss in pips. However, in reality, what is taken into account is the maximum negative drawdown assumed at any given moment in the operation's life in monetary terms relative to our account balance. That is, of the equity. You can monitor this in the maximum positive or negative drawdown section of the Strategy Analysis tab. That is, the size of the red bars, the loss bars. The larger these bars are, the greater the risk we have been assuming at some point during the operation, regardless of whether the operation ended up closing with losses or profits. 3. Size of the operations, positions. You'll also agree with me that it's not the same to open an operation of 0.01 lots as of 0.50. The larger the lot size we use, the greater the risk and vice versa. 4. Volatility. Depending on the market conditions at the time our operation is open, certain events can occur that significantly modify the speed at which the price of the asset's price moves. We're talking about high-impact news here. Lack of liquidity, or simply the market opening where volatility increases considerably during the first moments of the dance. When volatility is higher, the risk we are assuming is also higher. There is more uncertainty, and in a matter of seconds, the operation could go against us violently. 5. Duration of operations. Lastly, it's evident that the longer we are exposed to the market, the greater the probability of risk. In fact, it's often said that more time in the market means a higher probability that an operation in profit will turn against us. These are all the factors that go into measuring risk in Darwinex and Darwinex ZERO. And all this through deleverage, a Darwinex-specific leverage concept that we won't explain in detail in this video due to its complexity. But if I see enough interest, in the comments, likes, and so on, we might bring it to the channel. In any case, regardless of the statistical advantage you exploit for trading, it doesn't matter if you use more or fewer operations, more or less leverage, more or less time in the market, the important thing is to measure and backtest. Analyze the strategy's behavior concerning how the risk management engine replicates it in our Darwin. And based on that, decide whether to adapt it to a greater or lesser extent to optimize the Darwin's results, which, after all, is what matters here. Okay, the big question, what have I done to increase my multiplier? Simple. Reduce daily operations. The stop loss for operations has remained the same, the size of the positions has remained the same. Market volatility, more or less, has remained the same, always trading at the opening of the New York session, and likewise. The duration of the trades has also not changed. Understand that there's always a minimum variance in each of these elements each day of operation, but the changes were not significant. In case anyone is wondering, to decrease the multiplier, you just need to do the reverse process. Instead of decreasing these elements, you should increase them. You could perform more operations, extend the range of your stop losses, and increase the size of your positions. However, always proceed with this in a gradual manner, step by step, and with moderation, since it is much easier to lower the multiplier than to raise it. Going back to my book, I regret that I do not possess a screenshot of the average number of daily trades from when my multiplier was set at 19.21. But I do recall that the figure was approximately 4.20, give or take. At present, they stand at an average of 3.49 trades daily, as visible on your screen. Consequently, the multiplier, unexpectedly, increased from 19.21 to 23. Nevertheless, just yesterday, following the trading session, the following occurred. It kept rising to 24.05. Why? Well, because the 45-day window keeps moving forward, taking increasingly updated data from the strategy. And in my case, since I decided to raise the multiplier, I have been gradually decreasing the risk. So I would venture to say that it will continue to rise little by little until it stabilizes according to the new risk level one decide to assume, once I cease to reduce it. However, we will observe this as time progresses. Until that moment arrives or not, you should concentrate on what is genuinely important in Darwinex ZERO. And why we all came here. Reach gold. If you want to know what we'll need for that, watch this video. See you in the next.